Welcome to WealthNest, your home for traders, thinkers, and financial freedom builders. Whether you're just starting out or sharpening your edge, you're in the right place. Be sure to subscribe, like, and turn on notifications so you never miss a powerful insight. Just a quick heads up, all content here is for educational purposes only. Nothing shared is financial advice. Always do your own research and manage your risk wisely. You know, many people come to the markets with the wrong idea. They think trading is a way to get rich quick. They see stories online of folks turning a small amount of money into a fortune overnight. But honestly, this is a dangerous fantasy. Trading is not a lottery ticket you buy, hoping your numbers come up. It's not a casino game where you just place a bet and hope for the best. If you approach trading like gambling, you will lose your money just as quickly as a gambler. The market does not care about your hopes or dreams. It's a place of buying and selling, driven by supply and demand, not by luck. Success in trading is a result of skill, not chance. It is a serious business that requires a professional approach. Think of it like any other high-performance profession, such as being a doctor or a pilot. You wouldn't expect to perform surgery without years of training and a clear plan. You wouldn't try to fly a plane just by pushing random buttons. Trading is the same. It demands education, a solid strategy, and a deep understanding of risk. Believing that you can succeed without these things is the fastest way to failure. The market will gladly take money from those who are unprepared. The idea of fast, easy money is a powerful lure. It preys on our desire for a better life without the hard work. But this is a trap that has caught countless new traders. They jump into the market with real money before they have a real plan. They chase exciting trades without understanding why they are entering them. The result is almost always the same: a blown account and a broken spirit. The market is not a magical money machine, it's a battlefield where the prepared and the disciplined win over the hopeful and the reckless. True trading success is built slowly, one good decision at a time. So let's begin with the most important truth. Trading is a journey of self-mastery and strategic thinking. It's about managing risk, following rules, and executing a plan with precision. It's not about getting lucky. It's about being good. Forget the dream of instant riches and embrace the reality of building a skill. Once you accept that this is a marathon, not a sprint, you've already taken the most important step. You've shifted your mindset from that of a gambler to that of a true trader ready to learn the craft. To succeed in trading, you must think like a soldier, not a gambler. A soldier in the field does not act on impulse or emotion. They follow a carefully constructed plan. They understand their mission, their tools, and the rules of engagement. Every move is calculated and purposeful. If they deviate from the plan, they put themselves and their entire team at risk. Your trading capital is your platoon, and you are its commander. Your mission is to protect that capital and make it grow, but protection always comes first. This requires unwavering discipline. Discipline in trading means having a set of rules and sticking to them, no matter what. It means you do not trade when your strategy tells you not to, even if you feel a strong urge to do so. It means you take your profits at your predetermined target, even if you get greedy and want more. It means you cut your losses at your stop-loss level, even if you are hopeful the trade will turn around. Your emotions, fear, greed, hope, and excitement are your worst enemies on this battlefield. A disciplined trader learns to ignore these feelings and trust the plan they created when they were thinking clearly and rationally. Think of a highly trained sniper. A sniper does not fire at every target they see. They wait patiently, sometimes for hours or even days, for the perfect shot. They have a specific target, a clear entry point, and a planned exit. They know the exact conditions that must be met before they pull the trigger. Most of their time is spent watching, waiting, and analyzing. This is the mindset you need. Most of your time as a trader should be spent waiting for high-probability setups that match your trading plan. The goal is not to trade often, but to trade well. This patience is a form of discipline. Building this kind of mindset takes practice. It does not happen overnight. You must train yourself to follow your rules just as a soldier trains through drills. Start with a demo account to practice your strategy without risking real money. Write down your trading plan and review it every day. Keep a journal of your trades to hold yourself accountable. Every time you follow your plan, you strengthen your discipline. Every time you break a rule, you weaken it. Trading is a war fought inside your own mind, and discipline is your greatest armor. Many people use the words trading and investing as if they mean the same thing. but they are very different. The main difference between them is time. Investing is a long-term game. When you invest, you are buying a piece of a company, a stock, or another asset with the belief that its value will grow over many years or even decades. Investors are like gardeners planting a tree. They choose a good spot, plant the seed, and then let it grow over time, not worrying about the day-to-day weather. Their goal is to build wealth slowly and steadily. Trading, on the other hand, is a short-term activity. A trader's goal is to profit from smaller price movements in the market. Traders might hold a position for a few months, a few days, a few hours, or even just a few minutes. They are not necessarily concerned with the long-term health of a company. They are focused on the direction of the price right now. Traders are more like sailors, constantly adjusting their sails to catch the changing winds of the market. They are active participants, looking for opportunities to get in and out of the market for a profit. The risks involved are also different. While all market activities have risk, the nature of that risk changes. An investor's main risk is that the company or asset they bought fails over the long term. A trader faces more immediate risks. Because they are trying to profit from short-term moves, they can be wrong very quickly. They use tools like leverage, which can amplify both gains and losses, making risk management even more critical. A single bad trade, if not managed properly, can cause significant damage to a trading account. This is why traders must have strict rules for cutting losses. Understanding this difference is crucial for setting the right expectations. If you are looking for a set-it-and-forget-it approach to grow your retirement fund, you are probably looking for investing. If you're interested in actively managing positions to generate an income stream from market fluctuations, you're looking for trading. Both are valid ways to approach the financial markets, but they require completely different strategies, mindsets, and risk management plans. Do not confuse the gardener's patience with the sailor's active navigation. Know which game you're playing. You do not need a complicated setup to start trading. You do not need 6 monitors or expensive software that promises to predict the market. Those things can be distractions. Like a sniper who only carries what is essential for the mission, a trader needs a simple, reliable toolkit. The goal is to have a clean and efficient setup that allows you to focus on what truly matters, your charts and your decision-making. A cluttered desk often leads to a cluttered mind, which is the last thing you want when your money is on the line. Your first and most important tool is a good broker. A broker is a company that gives you access to the financial markets. They provide the platform where you can place your buy and sell orders. When choosing a broker, look for one that is regulated, has low fees, spreads and commissions, and offers good customer support. Do your research. Read reviews. Make sure they are trustworthy. Your broker is your partner in this business, and choosing a bad one is like starting a mission with faulty equipment. It sets you up for failure from the very beginning. Next, you need a trading platform. This is the software provided by your broker that you will use to analyze charts and execute trades. Most brokers offer popular platforms like MetaTrader 4 or TradingView. These platforms are more than enough for most traders. They allow you to view price charts, use technical indicators, and draw trend lines. The key is to learn your platform inside and out. You should be able to place an order, set a stop loss, and take profit without thinking twice. In a fast-moving market, you cannot afford to be fumbling with your tools. Finally, you need a way to keep records. This can be as simple as a physical notebook or a digital spreadsheet. This is your trading journal. Here, you will write down every trade you take, why you entered, where you placed your stop loss and take profit, and what the outcome was. You should also write down how you felt during the trade. Were you scared? Greedy? This journal is one of your most powerful learning tools. It allows you to review your performance, identify your mistakes, and see what you are doing right. A sniper debriefs after every mission. A trader should debrief after every trade. Every profession has its own language, and trading is no different. To really understand what's happening on your charts and in the market, you need to know some basic vocabulary. Trying to trade without knowing these terms is like trying to read a book in a language you do not understand. You'll see things happening, but you won't know what they mean. Learning these words isn't difficult, but it's honestly essential. They are the building blocks of your trading education and will help you understand your platform and communicate with other traders. So let's start with a few key terms. A pip is a very small measure of change in a currency pair in the Forex market. Think of it as one small step up or down in price. A lot refers to the size of your trade. A standard lot is a large size, while mini and micro lots are smaller, allowing you to risk less money per trade. The spread is the difference between the buying price and the selling price. This is how most brokers make their money. It's basically the cost of placing a trade, so you always want to find a broker with tight or small spreads. Another critical term to understand is leverage. Leverage is like a loan from your broker. It allows you to control a large amount of money with just a small amount of your own capital. For example, with 100-to-1 leverage, you can control a $10,000 position with only $100 from your account. This sounds great because it can really amplify your profits. However, it's a double-edged sword. It also amplifies your losses in the exact same way. Using too much leverage is one of the fastest ways for new traders to lose all their money. It must be respected and used with extreme caution. Finally, you'll hear about bull and bear markets. A bull market is one where prices are generally rising. Think of a bull thrusting its horns up. A bear market is one where prices are generally falling. Think of a bear swiping its paws down. Knowing the overall market trend helps you decide whether you should be looking for buying opportunities, going long, or selling opportunities, going short. Learning this simple language is your first step toward reading the market correctly and making informed decisions instead of just guessing. It turns a confusing screen into a map you can actually navigate. The path of a new trader is filled with hidden dangers like a minefield. One wrong step can lead to disaster. The good news is that most new traders make the same mistakes. If you can learn what these mistakes are ahead of time, you can learn to avoid them. The most common mistake is trading without a plan. A trader without a plan is just gambling. They buy or sell based on a gut feeling, a news headline, or maybe a tip from a friend. They have no defined entry, exit, or risk management rules. This is a recipe for losing money honestly. Another huge mistake is risking too much on a single trade. This is often called poor money management. A new trader might get excited about a potential opportunity and risk 10% or even 20% of their account on one trade. This is financial suicide. Even the best trading strategies have losing trades. If you risk too much, a few losses in a row can wipe out your entire account. A professional trader typically risks only 1 to 2% of their capital on any single trade. This allows them to survive a string of losses and stay in the game long enough for their winning strategy to play out. Emotional trading is a mine that blows up countless accounts. This happens when you let fear and greed control your decisions. Greed makes you hold on to a winning trade for too long, hoping for more profit, only to watch it turn into a loser. Fear makes you cut a good trade too early, missing out on profits. Fear also makes you afraid to pull the trigger on a valid setup. Revenge trading is another emotional trap. After a loss, you might feel angry and jump right back into the market to win your money back, usually with a bigger and riskier trade. This almost never ends well. Finally, overtrading is a classic beginner's mistake. New traders often feel like they have to be in the market all the time to make money. They take low-quality trades just for the sake of being active. This leads to paying more in commissions and spreads and taking on unnecessary risk. Remember the sniper. A sniper does not shoot at everything that moves. They wait for the perfect high-probability setup. Your job is not to trade a lot. Your job is to wait patiently for the best opportunities that your plan identifies. Avoiding these common mistakes is more than half the battle. In the world of trading, there are generally 4 types of personalities. Understanding them can help you see where you fit and which style you should aim for. The first type is the machine gunner. This trader is always in the market, firing off trades constantly. They overtrade, chasing every small price movement. They have no patience and are addicted to the action. They usually burn through their account quickly from commissions and a string of bad trades. They mistake activity for productivity, but all they are really doing is making their broker rich. The second type is the grenade lobber. This trader is all about taking huge risks. They don't have a precise plan. They just throw a large amount of money at a trade hoping for a big explosion of profit. They might get lucky once or twice, which reinforces their bad habits. But just like lobbing a grenade, their approach is unpredictable and dangerous. Eventually a trade will go against them in a big way, and because they are risking so much, it will blow up their entire account in a single, catastrophic event. The third type is the holy grailer. This trader is on an endless search for the perfect, magical trading system that never loses. They jump from one strategy to another, one indicator to the next, never sticking with anything long enough to actually master it. As soon as a system has a few losing trades, they discard it and start their search all over again. They do not understand that losses are a normal part of any trading strategy. Their quest for perfection prevents them from ever becoming a consistently profitable trader. Finally, there is the sniper. This is the trader you want to become. The sniper is patient, disciplined, and methodical. They have a well-defined trading plan, and they wait for the market to present a setup that meets all of their criteria. They are not interested in constant action. They are interested in high-probability opportunities. They know their entry, their target, and their exit before they ever enter a trade. They risk a small, controlled amount on each position. The sniper understands that trading is a game of waiting, and their success comes from precision, not from firing wildly. In trading, you can have the best strategy in the world, the fastest computer, and the most expensive software. But if you have not mastered your own mind, you will fail. Your psychology is the single most important factor in your trading success. The market is a mirror that reflects your own internal weaknesses. It will find your fear, your greed, your impatience, and your lack of discipline and use them against you. The real battle is not against the market, it is against yourself. Winning this battle is the key to long-term profitability. The two most powerful emotions you will face are fear and greed. Greed will tempt you to break your rules. It will whisper in your ear to hold a winning trade longer for a bigger profit, even when your plan says to exit. It will tell you to increase your position size after a few wins, convincing you that you cannot lose. Greed leads to overconfidence and reckless risk-taking. It is the emotion that makes you abandon your plan in search of a fantasy jackpot, a search that almost always ends in a devastating loss that wipes out many previous gains. Fear is the other side of the coin. Fear can paralyze you. It can make you afraid to enter a perfect trade setup because you remember your last loss. This is called analysis paralysis. Fear can also make you exit a winning trade too early, snatching a tiny profit because you are scared of it turning against you. This prevents you from letting your winners run according to your plan. The worst kind of fear is the fear of taking a loss, which can cause you to hold on to a losing trade, hoping it will come back. This hope is a trader's most expensive emotion. The solution to this emotional roller coaster is to build unshakable discipline and self-control. This comes from having a trading plan that you trust completely, because you have tested it and know it works over time. When you have total confidence in your system, it becomes easier to execute it like a robot, without emotion. You accept that some trades will be losers, and that is just a cost of doing business. You focus on executing your plan perfectly, not on the outcome of any single trade. Your mind is your greatest weapon. Train it, control it, and it will lead you to victory. To trade with the focus and precision of a sniper, you need a routine. A routine creates structure and helps remove emotion from your decision-making process. It ensures you are prepared and in the right state of mind before you ever risk a single dollar. Just as a pilot goes through a pre-flight checklist, a professional trader should have a daily checklist to follow. This is not optional. It is a critical part of a professional trading operation. It keeps you consistent, disciplined, and focused on what matters. Your pre-market checklist should begin before you even look at a chart. First, check the economic calendar. Are there any major news releases scheduled for the day, like interest rate decisions or employment reports? These events can cause extreme volatility, and it is often wise to avoid trading around them. Second, review your trading plan. Remind yourself of your rules for entry, exit, and money management. Read your core principles aloud. This reinforces your commitment to discipline before the market opens and temptation begins. Once you are mentally prepared, it is time to analyze the charts. Start with a top-down analysis. Look at the higher time frames like the daily and 4-hour charts to identify the overall market trend. Is the market in an uptrend, a downtrend, or is it moving sideways? You want to trade in the direction of the main trend, not against it. Mark key support and resistance levels on your charts. These are the important price zones where the market has turned before. This process creates your map for the trading day. Finally, your checklist should cover execution and review. Before entering any trade, ask yourself, does this setup meet every single rule in my trading plan? If the answer is anything but a clear yes, then you do not take the trade. You wait. There will always be another opportunity. After you are done trading for the day, update your trading journal. Record your trades, your thoughts, and your feelings. What did you do well? Where did you make mistakes? This daily routine of prepare, execute, and review is the foundation of consistent, disciplined, and successful trading. It turns chaos into order. Thanks for watching today's video on WealthNest. I truly hope you found value in it. So what was your biggest takeaway? Let me know in the comments. If this helped you, just smash that like button, subscribe, and tap the notification bell so you never miss the next trading insight, tool, or tip. We're building a focused trading community, one smart decision at a time. WealthNest, build, trade, grow.